Given that once again the world did not end, as many financial pundits suggested it would, I thought it would be worth having a look back at the week that was and having a bit of a look at some of the culprits for much of our panic and try to get a sense of where markets sit as we head into the new week. First thing I want to do is, as per normal, start with a 1,000-foot view and then begin to narrow in. Because once again, this gives us context. It gives us an idea of where we sit within the history of market. This is the S&P 500 index. This is a monthly chart. And as you can see, the monthly trend is up, bar the candle for this month. You can also see the remarkable generational bull run that the US market has had since recovering from the GFC. So monthly trend is up. Weekly trend, as you would expect, is down. It's not unusual to have 4 down weeks within a broader uptrend. And this is in part of the theme that I want to talk about and address. We come back to this age-old issue, and the issue is twofold. The first is the notion that markets never go down. Yes, they do. Markets have 3 states. Price goes up, price can go sideways, and surprise, surprise, price can go down. Unfortunately, we come back to the age-old problem of recency bias. People refuse to be students of the market and students of the history of markets. So they're constantly blindsided by it. Daily trend is down, and I will speak about some of the points about the daily moves in a few moments. If we look at the catalyst for this, and there are several very good narratives floating around about the unwinding of this yen carry trade, which acted as a prompt for the current rattling of everyone's nerves. This is the Nikkei monthly, and from about the end of 2023, the Nikkei had been doing quite well. It had slowly been grinding its way up from 2011-2012. The point about the Nikkei to be aware of is that it has taken almost 2 generations to recover from its collapse in the 1990s. It very much has been a moribund index. That has been its natural state of play. So it was quite unusual for it to begin to show signs of life. And of course, once it has shown signs of life and they begin to peter out, that rattles everybody. Weekly is quite clearly down. The 42,000 mark proved to be, in this instance, a bit too far for the index itself. Very interesting candle there from last week. In terms of daily, you can see the damage done from mid-July as the market began to capitulate, and you see these gaps opening up. You do see somewhat of a recovery last week, but the central issue here, and it's one I will speak to again, are these gaps that have appeared in price. These gaps need to be filled if the market is continued. That's fairly much a natural thing. If they stay open, then one's expectation might be that price will either become moribund and drift or drop further. Again, there is some debate as to whether the yen carry trades have fully been unwound. Once again, there's several different narratives about this floating around. The point to note, and I think this is a very important point, people are treating the notion of this unwinding of this yen carry trade as the end of the world. It is not. It does not have the importance that people are assigning to it, nor does it have the size. There seems to be this misunderstanding that this trade has for some reason been powering world markets for the past generation. It hasn't. The unwinding of these trades is not unusual. Yes, this is a big one, and people were caught by surprise because once again, people were caught in the notion of recency bias, in that there was this thinking that, well, during my period in markets, which is about 3.5 minutes, the Bank of Japan has never raised interest rates. Oh crap, the Bank of Japan has raised interest rates. That's never happened before. Yes, it has. And so you need to be aware of that. Yes, it's an event. Is it a world-changing event? At this stage, not. Is it as big as people think? At this stage, not. Again, it is a matter of context. It's a matter of understanding where you sit within the history of the market. This brings me to the first point I want to make. It is this notion of data, not noise. If you base your trading investment decisions off noise, then you will be forever caught by moves like this, and you will be blindsided and upset by them because you won't be aware of their capacity to occur, nor will you understand what the actual move means, because all you do is take in the breathless hyperbole of people who are desperate for attention. Once you become familiar with the vehicle you are trading and its perturbations and its ecology, you get a sense of what to expect. So your decision making should be based upon data, not noise. To give you an indication, let me ask a question. How bad do you think the falls were on the S&P 500? The quick answer depends how you look at them. These are the S&P 500 daily percentage changes, and I've taken this back to the 17th of last month when the market began to get a bit bumpy. When you look at this, you immediately think, good God, there's a lot of red and not very much blue. That's terrible. The world is coming to an end. Okay, let's have a look at the quanta of them. They're all small. This brings me back to an argument I present all the time. Absolute changes are bullshit. Relative changes are truth. When people speak about absolute changes, you can understand that they know nothing about markets. I have a few yardsticks to decide whether a pundit knows anything about markets. If they refer to something like volatility having a downward direction, then they know nothing about markets, because volatility is not directional in any sense. If they talk in absolutes and only concentrate on the price change and not its relative merit, then they also know nothing about markets. The same is true in part for when we look at the Nikkei. My data for the Nikkei, daily data, goes back to 1977. I couldn't get any decent data that went back further. What I've done is I've looked at the percentage change for the Nikkei on a day-to-day basis, and as you would expect, most values cluster around these two peaks. But you will see there is a large left-hand tail. So the Nikkei has a propensity to throw these very large daily relative changes. And if I blow up that left-hand tail, you can see that moving from about 3.4% down, there are a fairly significant number of large moves. There are even moves of 14%. We have one at 12 and a bit, two at 9 and a bit. So it's not unusual. Whilst it is not an everyday occurrence, it is an occurrence. So I went back and I looked at the Nikkei's outlier falls since 1987, and these are all the falls above 5%. What is interesting about the Nikkei is, running into 1987, it is very stable as the Japanese economic miracle unfolded and did its thing. Post-1987, where you seem to have this greater integration with world markets and more volatility slipping into the Japanese market, you begin to get these falls. As you can see, they're not unusual. The falls of last week are not unusual. They're not bolt from the blue moves that would take you by surprise if you knew anything about the history of the Nikkei. Yes, if you're a long investor, you do not want to be on the wrong side of them. But they're not unicorns. They have occurred in the past and they will occur in the future. This brings me back to this point. Understand the vehicle you are trading. Part of the issue for traders is they simply look at a narrow segment of time, or they drift in and out of an instrument. And in doing so, either of those in no way grant you any form of insight or understanding of what you're trading. You will often see people drift in and out of trading an instrument as if it is the flavour of the day or if it is this year's hula hoop. This is not how you trade instruments. Your focus must be constant so you do understand that when you see something like the Nikkei having these falls, you go, well, I've seen this before and I've seen it in the data. It's a thing, but it's not a big thing. So in terms of what we are seeing now, this is the S&P 500 daily. We can see the gaps. We can see early in August the failure to fill one of these gaps, and that is an issue. If you are bullish, you always want to see gaps filled. If I were bearish this, I would want to see these gaps remain open and price continue downwards. We are seeing a modest recovery, which we saw in the last two sessions of last week. Whether that recovery continues, we can really only say when we look back in a week, 2 weeks, or a month's time. But for me, the central issue here are the gaps. If they're not filled, that becomes problematic for long-side investors in the short term. My other point of concern, and I'm not certain whether it's a point of concern or just an observation, is this. It is the concentration within the S&P 500. You can see that a third of the total weighting of the index is contained in a handful of stocks, and it is largely concentrated in 5 or 6. The point to note, though, and I'll repeat this when I look at the NASDAQ 100, is that these are not your pets.com of the tech boom. These are actually companies that will dictate the way people see and interact with the world for the next generation or two. So they're not the rubbish that appeared prior to the tech collapse. And many people, unfortunately, are not able to make that distinction between the two. But it is interesting that the S&P 500 is such a concentrated index. Here's my other pop quiz. At present, is the S&P ASX 200 historical volatility above or below average? My guess is most of you said above average. Unfortunately, most of you are wrong. This is the historical volatility for the ASX 200 dating back to 2020. The average rolling 15-day historical volatility, as plotted here, is about 19%. Market currently sits at about 15 and a bit. Volatility is not what people think. Just because price moves down does not mean things become more volatile. That's not how volatility works. But there is a glitch in this, and it's always important to understand where you have glitches in your data. What makes the historical volatility look like it does is the COVID pop. It's an outlier. If we were to treat this as diving scores in the Olympics, we would delete that because it does drag the data in one direction. And if I delete it, we get a slightly different picture where volatility is now sitting slightly above its average or on its average. So when we talk about volatility, we need to be very careful about the history we use, because that history will dictate the picture we see in the present. We come back to this notion of data and the purity of data, but we also repeat this as a mantra in that you need to understand the vehicle you are trading. If we look at the NASDAQ 100, the NASDAQ 100 is always an interesting vehicle simply because of the gains it can generate and the movement it makes. As I said before, there is some confusion among punters as to what the fall in NASDAQ means. As I mentioned, many are treating it like the precursor to the bust and tech wreck. That's not correct. That's an incorrect understanding of history and what stocks make up the index at present. If you were around at the turn of the century, during the tech boom and the wreck, you would know that there was an inordinate amount of garbage in the market. You could take any vehicle in the world, put .com after it, and people would buy it. You could tell people that you were going to mail them pets in an envelope and call it pets.com, and people would buy it. These are not those stocks. This is not that index. Yes, it is very concentrated, and the concentration to a degree reflects the concentration we saw in the S&P 500. But that's simply the nature of the US economy and the way the world has turned. The world now is different to what it was 24 years ago, and the makeup of these indices is different. So we need to understand that and put this in perspective. So again, same comments as for the S&P 500. Gaps are a problem. If you're a long-side investor, you want to see those filled. But it also comes back to this notion of, I need to ask the question why you're trading the NASDAQ 100. If you're trading the stocks within it, all well and good. If you're trading the index as a wealth creation tool, you're trading the wrong vehicle. You probably should be involved in this. Cube, the ETF that covers the NASDAQ. So to look at our market as usual presents an intriguing picture, simply because it tends to over and then underreact. But because it has not had a dramatic bull market, there really isn't that much scope for it to drop its bundle and fall out of bed completely. Market's fallen about 300 points, 350 maybe. Not a big deal. And when we look at the percentage daily changes, and I've taken this back to the Friday before last week, so we fitted in the 2.1% fall, you see down 2.1, down 3.7, steady, down 0.2, up 1.2. So we loop back to this notion of data, not noise. A lot of the noise you would have heard about the market would be about the end of the world. But when we look at it in context, we don't see that. And when you look at a chart of the ASX 200, you do see that there are quite a number of blocky red bearish candles. This is not an unusual situation for our market to be swept along in what's occurring, but to not show any real damage. Yes, we've dropped back into this congestion period we were in, but that at present is the default state of the market. So in terms of where we are with regard to history, these are the drawdowns in the NASDAQ 100 and the S&P 500. These are weekly drawdowns, so you can see that at the end of last week, the S&P 500 finished down 4.83%, NASDAQ down 9.21%. Look at the history. This is not unusual. This is not even correction territory. The last correction the US markets had of any note was 2023. You can see the COVID pop. You can see a series of intermediate falls post the GFC. But what we're seeing now is nothing unusual. It's not a thing to all of a sudden run to the hills about. It may unwind from here, it may get better, but at present, based upon the information we have, and that's the only information we do possess, is this is not unusual. We see this all the time. And I think what has made it so distressing for investors is once again we come back to this notion that people don't understand that price can go down. It doesn't always go up. If you are convinced that price always goes up, you have a very childish view of the market and of the world. So in terms of where we are, this is the ASX 200 drawdown, down 4.19% as of the close of last week. You can see the COVID pop, you can see the GFC. You can see that this is an inconsequential fall by those standards and seems to be in line with a large number of other falls that we've had throughout our history. I think if there is something to be learned from last week, it is to ask yourself the question, how do you make decisions? What is the basis for your decision making? Is your decision making predicated on a plan that takes into account all contingencies, or is it a fly by the seat of your pants, make it up as you go along decision making matrix? The former is the hallmark of a professional. The latter is indicative of being an amateur. If your decision making is based upon what you take from social media and the general media, then you will forever be caught by these sorts of moves and not understand that firstly they're natural, B, there is an opportunity to make money, and C, they're nothing to be frightened of, because you would have at your command a chart like this, where you would look back and say, well, markets go down, markets draw down. Markets are weighted indices, so it may be that my stocks have not gone down. If I'm an index trader and I'm long the index, then I would know that this is an occurrence and that I have to plan for it by having stops in place. The same is true looking at the US markets. If I had been long US markets, and there is no compelling argument whatsoever to have been short US markets for anything other than the briefest of times over the past 20 years or so, then I would understand that this is an occurrence I should be ready for. So we come back to this question, and it's a very important question you need to ask yourself. How do you make decisions?